Okay, I'll just check you guys can hear all right. Doesn't sound like enough. How's sound over here? Is it okay? Not very good. Okay. Right. Okay, is that better? Is that better? Is that any better? It is better. Okay, good. What about you guys up the back? You okay for sound up there? I think that's a nod. And you guys okay for sound? Right. Okay. It's gone 1 o'clock, so we'll make a start. Just two brief announcements. One is that I have the final, or the second of the 2 feedback meetings with the class representatives tomorrow. So if you have any comments you want to make on the course of any sort, get to those to the class reps. Plenty of time for that meeting tomorrow. Now, this is the last lecture where we'll have new content. On Friday, there'll be a review lecture. So if you want me to go over any particular questions that you have, can you email me those basically as soon as you can, because there's always more questions than there is time to answer them. So if you get yours in early, then you will probably be the ones to get your questions answered. So Friday will be a review lecture, and we'll cover whatever comes in, and I'll talk a little bit about the final exam as well. Okay, so we'll just briefly review what we did yesterday about investment banks. Now, investment banks, although do a wide range of things, their core business is to bring new securities to markets. And so they're basically there to help companies primarily, and to some extent governments, to raise funds. That's what their main business is. Now, because the name bank is legally privileged in New Zealand, if you have a company which is only doing investment banking work, then you will not see the name bank in its company name. It'll have some other name, and then you'll have to sort of dig a bit deeper to find that they do investment banking. In Australia and New Zealand, we have here what is quite common throughout the world, what we call universal banks, and those are banks which combine both the commercial banking and the investment banking into a single institution. That's not the case in some places like the United States and Japan, where these things have been separated at various times. But here, an ordinary commercial bank can also have an investment banking arm. We talked a little bit about how they bring the new securities to market. For example, an IPO or any other security being brought to market, the most common one is an underwritten offer. In an underwritten offer, the investment bank buys all the securities at a set price from the issuer, and then they on-sell those to other investors. And the difference between what they pay the issuer and what they receive from the investors, that's called the underwriting spread, and that represents their gross profit. But while they hold those securities between when they've agreed the price and when they go on and sell them, they actually are subject to price risk. The other way that they do it, which is less common, is what's called the best efforts offer. And in that particular case, the investment bank provides the services, their services, to sell the securities on behalf of the issuer, but they do not buy them themselves. They simply do their best to sell them, and they do not guarantee either price or quantity sold, and for that they simply earn a fee. The other thing that we did cover is that you often see investment banks involved in the secondary market. When issuing securities, we're talking about their involvement in the primary market. We often see them involved in the secondary market in one of 2 roles. Often, if the type of security that's being issued is listed on a secondary market that is of the exchange type, you often see an investment bank with something like a share broking arm, and so you can have an account with them and you can buy and sell shares through an investment bank. And one of the examples we mentioned yesterday was Macquarie, which is an investment bank, has Macquarie Private Wealth, which is its share broking arm, so you can trade that way. The other way you may see them involved is if the type of security that has been issued is not going to be listed on exchange, often the issuing or the underwriting investment bank takes the role of being the market maker, and they become a dealer, and they will make a market in those particular securities. So that brings us basically to this point here. This is another thing that investment banks get involved in with project finance. So what is project finance? How does it differ, say, for example, from a bank loan? How is project finance different from, what is it? How is it different from something like a bank loan? Yeah, go ahead.
I think it's the project finance is more risk involved. Say that the investment banking itself has involved in the project. So on the other hand, the bank loan is like lend out money. So you don't
Okay.
involve them with this money invested in.
Okay, so one of the points is that, yeah, this stuff is project loans, project financing is definitely higher risk. But the question is then, where does this risk come from compared to a bank loan? And if we look at what they actually are, this is the point, is that the project itself is the thing that gets financed. Now, you often see this involved where, like, you have two or more companies and they go into a joint venture to start something brand new. Like, for example, you know, say there was this offshore oil field and several different oil companies had, you know, poked wells down, they actually found oil. They might create a special company which would then lay the pipeline and would carry all the oil from out in the field onto shore. And so in that particular case, what would happen is that because they had set up a separate company, that project would be the thing that would be funded. And so the individual companies, you know, like say it was BP and Mobil and those sorts of ones, they would not go and get finance themselves, but the company that they created for this project would be the ones that seek finance. Now, here's an important point on it. It says the finance usually issued on a limited recourse basis. What does that mean? What does that mean? Say, for example, we've got just two oil companies, BP and ExxonMobil. They're going to build this pipeline, but they create a special company which they jointly own that's going to get funded, and they're going to be funded in this particular way. So let's say, for example, the pipeline had troubles, and it didn't make much money, and they ended up not paying what they should. What does the limited recourse mean in that situation? Yeah.
Would it be that to like go back to the lenders or whatever, the maximum they can take is like what the project had and not what the parent company had?
Yeah, so it's limited to this company set up. So, for example, if we have BP and ExxonMobil, and this new company that they created together that they jointly own has trouble, they cannot go back to the parents to ask for the money. And so that's one of the things that makes them a bit more risky, is that although, you know, the parent companies may be very well off themselves, if it's limited recourse, then the lender cannot go to those companies and require payments. Often these things are quite large when they use this sort of stuff, and it's not uncommon to see, you know, not just a single investment bank get involved, but you'll get a group of them involved to spread the risk around. The other place we tend to see them, sometimes, you know, if you get partnerships between the government and the private sector, for example, building a toll road, building a hospital or something like that, you'll see project finance in those sort of situations where it's something, a legal entity specifically created for that project, and then that project then has to somehow earn enough money to pay the lenders back. Okay, any question on that before we go to mergers and acquisitions? Okay. So the question is why is mergers and acquisition business attractive to investment banks? There's a couple of interesting quotes, because there was this time in the 1980s when we had this merger mania and people were just merging everything that moved and plenty of things that didn't move as well. And this first one is actually from the New Statesman magazine. It says the city, and that refers to the financial district in London. It says it's unpatriotic casino which pays itself obscenely high salaries for dancing on the grave of British industries. And the reason they sort of said that, it was that this huge merger mania was actually quite destructive over the long term in terms of the businesses that they merged together. In fact, they went through this merger mania in which they were supposedly finding synergies between companies, and then not much longer later, they actually started taking companies apart again to unlock hidden value. And one of the fastest, you know, cycles of mergers to create synergies, to then unlock, you know, taking them apart again to unlock hidden value was under 3 years. So they turned these things around pretty quick. The other one, this guy here, this Sir Klaus Moser, he was the director of Rothschilds, which is still one of the 50 largest investment banks in the world. So he was one of their board of directors, and this is what he had to say about things. The city, again, that's the London financial district, is absorbing far too many of our ablest people. If I were dictator over Britain, yeah, sure. I'd move 9/10 of them into manufacturing industry and teaching. Even as an investment banker himself, he didn't really like the fact they were doing all this merging and acquisitioning stuff. But anyway, interesting stuff. But anyway, why do investment banks get involved in mergers and acquisitions? What's in it for them? Yeah, go ahead.
It's just to provide a speculative opportunity for make profit.
So where would they make their money on a merger or an acquisition? Where would they make their money?
So first, they could so they make the consulting fee.
Okay, so big fee there for consulting, and often in that sort of merger mania, they weren't just consulting; they were actively out there looking for companies that they can put together as a merger, and then they would go to approach both of them for a merger. So consulting is one place where they make money. Where else would they make money on a merger?
Second, they have ability to access the inside information so that they provide speculation opportunity for themselves.
Okay, now, in terms of access to inside information, that's usually part of their due diligence, and they, how would one say that? They would not trade on their, they should not be in trading on their own behalf on inside information. That's actually illegal. Okay, so that's actually illegal to do that. Anywhere else they would make money? One of the other things where you would make money on these things is often, not so much in a merger, but particularly in the case of acquisitions, often new securities have to be issued. And so if you're going to buy a company, either you have to issue new shares or you issue new debt. And in both cases, the investment bank that's advising the company would then be involved in the underwriting. So they would actually, essentially what they're doing in that particular case is creating underwriting business for themselves by getting companies to merge or be acquired. One other thing they can do is that if you're on the receiving end, particularly of an acquisition, and you don't want to be acquired, you can hire an investment bank, and of course, for a big fee, they'll help you to fight off a takeover offer from somebody that you don't want to be taken over. So it doesn't matter which end you're on, whether you're advising the client that is going to do the takeover, or you're advising the one that's being taken over. They can make money on either end of these things. Now, some other things they do, as you can imagine, when you look at an investment bank, they've got a significant amount of financial expertise on board, and pretty much anything they think they can make a good return at, they'll put their hand to. And so if you're just an ordinary company and want some advice on your capital structure, which hopefully you've covered a little bit in 201, and there's other courses at third year that cover this, dividend policy, how much you should retain, how much you pay out. They're looking at large projects, and you need some specialist advice on the feasibility of those. You go to an investment bank. Large real estate purchases, if you're selling something like Westfield and Rickerton's, you often get an investment bank involved in that. And typically, when things are being securitized, often companies that are doing securitization often don't have their own expertise on board, and so you would hire an investment bank to do that for you. Okay, any question before we go to venture capitals? Yep, got a question?
Consider that for the investment bank, they involved in the security expectation.
Yeah.
Is it do they own the SPV?
No, they will do all the legal work required to set that up, and buy the loans, stick them in there, if say, for example, mortgages, do the dividing up in security, do the underwriting, and bring them to market. They usually do all that sort of stuff on behalf of the other issuer. Particularly if you get the case where the issuer doesn't have that expertise internally, they'll hire an investment bank to do all that. But the investment bank themselves won't actually ever own the special purpose vehicle, or in the end, they usually don't even hold the end securities.
So The
Yep.
SPV is a completely separate entity.
Yeah, it is a separate entity, and like one of the things that makes when you hear the phrase "too big to fail," with respect to some of the very large banks like in the United States, and the issue there, according to some people, is that it's not sheer size. It's this legal complexity, and it's not uncommon for those large banks that do securitization to have quite literally thousands of legal entities inside a single company. And for every SPV, I mean, the bank actually sort of holds that thing, and it becomes part of the bank's structure. And so the investment bank, will do all the work, if you hire them to do this, to make the SPV, but the SPV will be held by the original issuer, not by the investment bank. So basically, they're earning some fees and moving on to the next job. Okay, any other questions? Okay, so coming to the very last topic, venture capitalists. This is another tiny area in the economy, but one of quite a bit of important, high importance. So this is it doesn't show up very well, but these blue bars, which you probably can't see very well. I wonder if I turn them up. Better? Yeah, they show up there. This is the amount in dollars that is being raised by venture capitalists this is 2007, and this is up 2016 here, for investment. And so for a while here, in this period here, they were barely taking in 100 million a year. It's ticked up in the last 2 years, and it was fairly close to 400 million there. So we're talking about really small amounts of money as far as the financial system is concerned. But what makes them important as far as an economy is concerned is this is one of the key areas that drives innovation and new businesses. So particularly new types of businesses, and they get involved in making sure that those things start, they grow, and they eventually become profitable and eventually get put on an exchange somewhere. But it renews the economy. It is the source of a lot of innovation. And in terms of private sector research and development, significant amounts of money come from the venture capitalists. And so it is there to drive innovation in an economy. So even though it's tiny, $400 million is really small compared to some of the other things we've talked about in this course, it's quite important in keeping an economy growing and active and moving along. So, what is it? And what services do they provide? So what's venture capital? I think we'll say it. What services do venture capitalists provide? You were going to have a venture capitalist help you build your company. What sort of services would they provide you with? Yep.
First, they definitely provide funds.
Okay, money. Well, number one, money. Yeah, very, very clear, money. Anything else?
And they might consider they're the one providing money, so they might focus on management decisions.
Okay, so they get involved in management decisions, and this is one of the key things that separates them from something, say, like a mutual fund. A mutual fund may buy shares in the company, but you'll almost never see a mutual fund manager actively involved in managing that company they have shares in. Whereas these people, they do. They get actually involved in the day-to-day running of the company and its management. Anything else they might get from them? Just roll over. So I found this. This is just sort of gives you some idea of how they differ in one respect compared to. Okay. So, how do venture capitalists spend their time? When you think about what they do, they got to find investments and so on. You put all that together. They're quite small. So for soliciting business, selecting opportunities, analyzing business plans, negotiating investments, and exiting, you put all those together, that's only 30% of their time. when you look at this big block in here of 4, serving as directors and monitor, so they're actively involved in the companies, about 25% of their time. Acting as consultants, that's to the companies that they are invested in, another 15. Recruiting management, so actually getting good people into management, another 20%. And assisting in outside relationships, building connections between the company they invested in and their markets, another 10%. And so those things together, those 4 things, about 70% of the time that a venture capitalist puts into their work is actually directly invested as time into the companies that they have the stake in. So this is quite different from buying shares and poking them into your portfolio and hoping they appreciate in value. These people are actively involved in the companies that they're investing in, trying to build these things up to the point and where the thing can have an IPO, at which point venture capitalists exit their investment and go on to something else. So I've got some updated data on that one as well. So let me grab this one here. So this is venture capital. Let me just see if I can it'll land. No, it might turn off. Okay. So this is the venture capitalist capital investments in the financial year 2016. And this one on this side is in dollars, so that's the value. And this one on this side here is in terms of numbers of companies they invested in, and they're color-coded as to what they are. So if you think about where's the money going to, this light blue one, here's one here, that says ICT. That stands for Information and Communication Technologies. Remember yesterday we had something called TMT. This is basically the equivalent. So this is, computers, networks, and all that sort of stuff, and any of the services that run on those. So by number, about 39% of all investments end up in this sector, but by dollar value, about 47%. Almost half of all money is going into essentially a high technology center. Go to the next one, healthcare and life sciences. That's this group here. By number, about 32%, so that's approximately 1 in 3 is a life science or healthcare, something like that. But by value, it's only about 13% by dollars. Next group around here, this orangey one, consumer products, services and retail, 11% by number, but about 15% by value. Financial services, 11% by number, but 13% by value there. And then a couple of smaller ones there. That's energy. And then the real dark blue one is just everything else. So the biggest chunk is, particularly in the dollars, the biggest chunk is going into information and communication technology startups of some sort. And when you talk about being involved in high tech, this is often where you see them in these types of areas where there's new technology to be developed, and then ultimately, hopefully, a new product or a new service will come to the market, and they will make their money out of bringing that thing all the way, sometimes from just an idea through to a company that is then listed on the share market at some stage. Okay, so what are the stages? What are the stages so if you were a venture capitalist and you're going to invest in a company, what stages that you could you invest at? Nobody knows. Okay, so there's a whole group of them, and this is a chart that tells you where the money goes, but they don't have very helpful names. But anyway, well, group of them don't. The first one they could do is someone could seek money at what they call the seed stage, and that is basically the idea stage. So you've got an idea, but not much more than that. And these are by years. That's 2012, 13, 14, 15, 16, and this is by number, and again, same years, and these are by investment amounts. So if you take the most recent year, 2016, by number, 22% of all venture capital investments were in what they call the seed stage. This is where a person basically has nothing much more than a good idea. So about 22% of them go in there. But when you look at the dollars, only about 6% of the dollars go into that seed stage. Okay, so it's just getting things going. Next one up is the startup financing. So you're actually going to do not just have an idea, you're actually going to try to make, if it's a product or a service, try to actually make it. And by number, here it is in the most recent year, 38% of investments by number were in the startup phase, but only 25% by dollars is in that startup phase. The next thing, they've got this thing called other early stage, and that's probably what on this list over here is the first and second stage, probably not the third. And so other early investment, again, here it is about 15% by number and only about 13% by dollars. The biggest one in terms of dollars is this late stage stuff. So basically, once you've got your company moving along and it looks like it's going to go, then you've got to somehow ramp this thing up to the point where you have a product or a service and you can actually go out and sell it in volume. And in terms of number, in the late stage, about 25% here in the most recent year, but over half of the capital went into that late stage investment. So this is sort of the stage that you get in, last stage before you finally bring it to market, and you as the venture capitalist will sell your shares on an IPO. We can get even more extreme times like here in 2014, in these late stage by number, again 25% by number, but 80% of the capital from the venture capitalists in that particular year went into the late stage development of those companies. So that's sort of, what happens is a lot of these companies fall by the wayside. So you get a lot of ideas, and they're putting money into what they think is good ideas. Of course, a lot of those don't come to fruition, but ultimately some do. And that's where they hope to make their big money, is off the ones that do come to fruition, and then they can sell them on an IPO. Now, if you watch the movie Boiler Room, which is another financial movie, and you think, what on earth are they doing in that movie? They're actually involved at this stage here of IPOs. So if you watch that movie and think, what are they talking about when they're talking about mezzanine financing? Because they actually mention that in the movie. It's part of growing a company to the last stage before you actually take the thing out and sell it to the market in an IPO. A couple of other things that you can find them doing. Usually these are rather specialist types of venture capitalist funds. There's turnaround financing. If you find a company that is, in your opinion, has a sound business, but for whatever reason has gotten into financial trouble, then you as a venture capitalist can go in there and rescue the thing and turn it around. Management buyout, sometimes they get involved in those, although this tends to be much more something that the investment bank will do, is that the managers will raise the money either from venture capitalists or more commonly from an investment bank, and they'll buy the business off the current owners. So, if you wanted to be one, if you wanted to be a venture capitalist, how would you get there? Like, who are they, and how would you become one? Yeah.
Superannuation fund managers.
Well, they don't normally become a venture capitalist, although you often find those types of fund managers will invest in venture capitals. But you don't often find, like, within, say, a super fund themselves, you don't often find a venture capitalist there. But you will find super funds investing in a venture capital fund. Well, okay, we'll roll over. The common one is, at least for the major ones, is that typically people who are in venture capital have actually started off with a little company, and they've grown it to the point where it's been an IPO themselves, and they've taken a lot of money out at that point, and then they've gone on to essentially start investing through venture capital. So they use the expertise that they developed themselves by starting a company, taking it through to the point where it's listed on an exchange, and they got a big chunk of money, and they use that expertise to become venture capitalists. So that's what you tend to see, the major ones. Now, This other stuff about the high returns and high risk, again, this isn't, this high risk sort of stuff is not like a mutual fund manager. They don't just buy companies and watch. They get actively involved. And in terms of where they get their money from, superannuation funds are a common one, but some of these, it's rare to see these open to the general public, but occasionally you will see one. Sometimes, New Zealand government has set up a venture capitalist fund, as does Australia. They have venture capital funds that are actually funded by the government. And so any place that sort of has a long-term view, not a short-term one, can be a source of funds for them. Now, what if you wanted to get money yourself? It's pretty tough. So basically what happens is you've got to give them a very detailed business plan about what you're going to do, and typically they toss out 90% on round one. They're not even interested, and you get tossed. If you make it into round two, typically there's another 10 to 1 step down. So basically in terms of the number of applications that come in to the numbers that get funded, typically it's around 100 to 1. So the chances of actually getting money out of these things is pretty tough. But there are places. How many people have heard about the rocket launch up on East Cape? Yeah, several people have. Yeah, they have money from several venture capitalist funds that have funded them over the years that they've been developing those rockets. And so, you can get it if you've got a really good idea. Said most of that. Oh, one point here. If they're going to invest, say, why would they take preferred stock rather than common stock? Yeah. Yeah, so that's the key point there, is they're looking for some protection in case of things going wrong, which is pretty common. Common stock's down the bottom, preference shares a little bit above that, and so if a company is wound up, they will get their money before the original founders would. Now, here's sort of, kind of makes it sound really good. They think in terms of multiple amounts of they invested, and like, for example, here you see 47%, think, wow, let me in. And you might ask, well, okay, dream on. What do they really do? So what do they really do? This is U.S. data, but it does actually tell us a very interesting story. So this is the CA is the Cambridge Associates, is the people that write this report. So this is U.S. venture capital here along this line. So that's last quarter, year, 3 years, 5, up to 25 years. And they've got several major indices, stock market indices for comparison. That's the NASDAQ, the Russell 2000, which is a major one, and Standard & Poor's 500. So if you look at their returns, and you think, well, they want vast amounts of money, in recent times, they've actually done quite well. So last year was only 4.8%, but 3 years, and this is compounded per year, 3 years at 19.4%, and 5 years at 14.6%. That's really good returns. But you can see also that, like, for example, on the NASDAQ, if you're invested in an index fund, 16.7 for that 3-year period, that's a bit behind. It's a bit behind. And in 5 years, the NASDAQ's, just over 1% below. So they are earning more in general. At this point here, it's only 0.7 difference over that 10-year period. But here, 15 years, it's actually the other way around. If you'd invested in the NASDAQ over the last 15 years, because this goes up to 2016, you would have earned on average 9.1% per annum compounded over that period. Whereas if you were a venture capitalist, you would have been down at 4.9. So that's a significant drop there. But then you go back 20 years, and this is where it really starts to stand out. The NASDAQ did 9.3% compounded per annum for the last 20 years. Venture capitalists did 20%. I thought, not 20%, 30%. And you think, you go back 25 years, it's 25.1% against 10.8. And you think, how come they made so much money then? And why have things not been as good since? Now, there's a reason for that. And when the guy, you probably heard the phrase disruptive technology. Yeah, how many people heard that phrase? When the guy cooked that phrase up, he was talking about like once or maybe twice in a lifetime type changes in technology that really did change the way the world functioned. And what we see in this period is the fruition of one of those disruptive changes, and that is that the computing device became sufficiently small and sufficiently cheap that individuals could have them. Now, there may be boxes that you had to stick under your desk, but you could buy one. And not only did that happen, the other thing that happened was that there was a worldwide network actually set up, and so you could connect all over the place. And those two things came together in this period. If you think back when that actually was, that's like the early 90s through to the mid-90s. That's when that sort of computer revolution really took off, and there was huge amounts of money being made because you had an entire industry that did not exist being created. And basically, we have not seen anything like that since that time. And you don't get these every day. These are rare events, enormous changes. Another change, if you go back further in time, was the replacement of the horse by the private motor car. It was an enormous change. And if you're right there at the right place, right time, there was enormous amounts of money to be made. But after that point, although certainly technology has advanced, the speed of change, in one sense, people say it's speeding up. In actual fact, a lot of people think in actual fact it's slowed down. And if you think, take an example, to go from no telephone at all to a telephone is an enormous leap. To go from a telephone that's tied to a wall to one you can put in the pocket is an improvement, but it's not a big deal. Okay? So these radical changes, they're pretty rare, but if you're in the right place, right time, there is, huge amounts of money to be made. 30% compounded for 20 years, or even 25.1 compounded per year for 25 years. There was enormous amounts of money made then. And who knows when the next major revolution is coming. But if you're in the right place, you make lots of dollars out of this stuff. Okay. Any questions on that before we check along? Yeah, go ahead.
For this venture capitalists, are they actually the entrepreneurs or the management?
No, these aren't actually the returns to the founders of the companies. Like, for example, if you're trying to say, would Bill Gates be in here because he founded Microsoft? No, he wouldn't be considered in this lot here. If he got money from a venture capitalist, and say venture capitalists invested in Microsoft at the very early part of its life, that would be the returns that we're talking about here. So this is not people like Bill Gates and Steve Jobs and those sorts of guys who actually build the companies and they're the initial owners. These are the people that come in at a slightly later date and put money into it. And this is the return on their investment. Yep, go ahead.
In terms of the concept of crowdfunding, is that similar to this or not?
Crowdfunding is in one sense, it's a type of direct funding. And when you think about these venture capitalist funds, they're often closed to the general public. But when you look at crowdfunding, often the types of companies that a venture capitalist would invest in, if you go for crowdfunding, invest in crowdfunding, they are the same types of companies. So in one sense, you're through that type of platform, you can get access to the type of investments that these people are making. Because normally you can't directly invest in a venture capitalist fund. Okay, any other questions? Right. Often they're quite difficult to value. If you try to figure out what on earth these things are worth, if you're a venture capitalist, what they're worth, it's very, very difficult. If you're looking at comparable, sometimes, if it's really new, there's nothing to compare with. But standard things of how much they're earning, what their price to earning ratio, and that sort of stuff is. often at this stage of the investment, these things are not, they're not easy to measure, but also they're not a very good indication of how they're going to go in the future. The multiple scenarios valuation, usually what they try to do is, look at, well, what if this thing really goes well? Better than we expected. What do we sort of genuinely expect to happen? What if it goes worse than we expect? And they try to make some educated guesses about what will happen and then apply some valuation techniques for this. So this is one here. So in terms of that one there, probability of outcome, the pessimistic one, that is, this company that we've invested in is not going to do as well as we thought. They've given a 30% weight to that. The expected, this is one I think really is going to happen, to give a 50% weight to that. And chances that the thing will actually do better than we expect, they've given a 20% weight there. And then they've looked at the revenues, again, looked out in their crystal ball and forecast these however they do it, 10 million through to 40 million. And then their profit margin, goes up from 5% to 10%. And this is the PE ratio at sell, that's the IPO. And then you come out in the company valuation in this line here. And there's significant difference. So in your pessimistic view of the world, that your investment in this particular company will only be worth $3 million at the time that you take it out to IPO. Under expected, it's going to be worth $20 million, and if it does really well, you're expecting it's going to be $60 million. And you sort of weight the whole thing together to get a current valuation. So if you about 30%, times 3 is 0.9, 50% times 20 is 10 million, 20% times 60 is 12 million. Put them all together, and your estimate is that it's currently worth 22.9 million at the time that it gets taken out for its IPO. If you want 45% per year, and this is looked at here, year 6, you can work out that the thing's worth 2.5 million today. So that's the basic idea, and of course you can see that that the current value is quite small because of the high required rate of return on the company. Now, let's do this one here. Okay, so let's see. How would we work this one out? Grab the paper here. So the idea is that the venture capitalist requires 40% rate of return per year. Good luck to him. Anyway, venture capitalist thinks that a company will be worth 50 million in 5 years' time. So they look in a crystal ball, or whatever they do to work out that number, and they're going to ask themselves, well, somebody's come along and they want some money, and they want 3 million from us. Okay, they agree to do this. And the question is, how much of the company do they need to buy? So how are we going to work out what proportion or what percentage of the shares they should buy for their $3 million based on the data we have here? What will we do? Ooh, all very quiet. The first bit of it is really quite simple. Remember this formula here, present value equals future value over 1 plus I to the power n. What's the future value? $50 million. Yep, that's the 50 million there. And what is the I? 40%, and if we convert that to a decimal, it's 0.4. So this is 1.4 to the power n. And that means that, if we do that, that comes out at about 9.3 million today. So it's just a present value from future value calculation. Okay, so that's what they think the company's worth at its present value. And so if they're going to put 3 million into that, what percentage of the company will they need to own? 31%. It's quite close. The way you do it is that the percentage ownership is going to be 3 million that they put in divided by the 9.3 million that I think the thing was worth in terms of present value, and that would give them a 32.3% ownership. Now, the other thing you could do, quite reasonably do, is say, well, if you put 3 million in, it's obviously going to be worth more today. And in that case, if you thought that was how you should value it, in that case, you would still be putting in your 3 million, but the 9.3 would now have your 3 million, and it would be 12.3 million. So this is what you normally do, but it is quite reasonable, depending, if you have a bit more detail, to do that calculation there, and that would give you just a whisker under a quarter of the company. So, unfortunately with these things, when you think about, the requirements at 40%, and that's not an uncommon figure, but when you look at the real returns here, going back here 10 years at 10.2, 15 years at 4.9%, the truth is that a lot of these things end up going bad. They basically cost you money and you earn nothing off them at all. You actually earn a negative return because so many go bad. And every now and again you get a good one, and that good one is the thing that gives you the return. And hopefully, as an venture capitalist, it'll keep you in business and keep you wealthy. So that's the end. So that's the last bit of the course. Friday will be a review time. So if you have any questions, please email them to me, and I will try to answer them on Friday. Okay, so that's the end of the contents. If you want to ask any questions, be around for a while. Otherwise, I expect we'll see most of you on Friday. Too bad if you don't.